In the next 10 minutes, I'm going to build a complete real estate tax plan from scratch for someone making $500,000 from a W-2 income. There won't be any theory, there won't be any vague concepts this time. But I am going to take a hypothetical client, walk you through exactly how I'd structure their tax plan, and run you through their specific numbers. And by the end of this video, you're going to see exactly what their tax bill looks like before and after if they implement these things. This is essentially what happens if you sit down with me for a consultation. Except right now, you get to watch it for free in a very condensed manner. I'm Ryan Carrier. I'm a CPA and founder of Carrier Tax Consulting. And what I found is that most people in this income range have no idea what's possible for tax savings and how much they could realistically save after running through some of these numbers. So that's my goal. That's what I'm going to run you through. I'm going to walk you through the client profile, show you which strategies I would recommend and why, and then I'm going to quantify the tax savings with you, so you can see some of the full picture items of these main highlights of their tax plan. So let me set the stage of who we're building this tax plan for. We've got a hypothetical scenario here. You can see it on my screen. We've got the filing status is a married filing joint couple. They've got 2 kids. We're gonna say that they're 10 and 12. They're in the state of California. I could have chosen another high income tax state, which is another one that I typically see like New York and such places like that. The income, so we've got spouses, so I'm separating out the 2 kind of income sources just to show this, and I'll explain more later. But the primary spouse is a W-2 earner, and the other spouse is a homemaker, and that'll be important again, a very typical situation that I see. The W-2 earner is going to make a household income. Obviously, there's the sole breadwinner, $500,000 from their W-2. That's going to equate to about $103,000 of federal income tax. That's kind of a rough estimate. Today, they have 0 rentals, but their goal in working with someone like me and reaching out is they want to reduce their taxes as much as possible using some of the real estate tax strategies. So that is a very, very, very typical client that comes through my door and is great because of some of the things that I'll walk you through next here. And the reason this is a good situation for me is because they're a high income W-2 earner. They don't have a lot of other offsets that they can use for their W-2 other than things like HSA and 401ks. And I'm just kind of assuming that those things are going to be done here. So I'm going to remove that from the tax plan. And let's say that they've never really done any formal tax planning. They've just been working with a tax preparer their whole lives. All right, so now you can see where this person is starting from and where we're about to go. So let's actually build the plan together next. And by the way, this is exactly the type of tax planning that I do with my clients at Carrier Tax Consulting. We sit down, we look at your numbers, and we build a plan that's specific to your income and your goals and what you're comfortable with. If you're watching this and your situation looks anything like what I just described here, the link to book a call with me is in the description, and I would love to speak with you. But for now, let me show you how this plan works. So now the question is, what strategies would I recommend for them? And maybe more importantly, why these strategies over some other ones? So let me explain a few things. So looking up here at the top, you can see I've got a few core pieces to their strategy that I want to make sure is clear to them. So number 1 is the short-term rental tax strategy. Before I dive in too much more into numbers here below, I'm recommending the short-term rental strategy over real estate professional status, because especially with where we're at and for most people and just the time that they have, even if they have a spouse that's currently a homemaker and not working at a specific day job, the amount of time that that spouse has into meeting the real estate professional status trades or businesses of 750 hours is usually just something that most spouses do not want to sign up for. Now, I have worked with clients in the past where the spouse comes in and maybe doesn't have a day job, but they come in being like a real estate agent or a flipper or a wholesaler, and they right away already with what they're doing are able to meet the 750 hour criteria. And if that's the case, then we're talking about either meeting the short-term rental strategy or real estate professional status with long-term rentals. So for this couple, I'm assuming the spouse is not doing any sort of real property trade or business, and that is the most common, which is why I'm assuming it as we kind of talk through these things here. So short-term rental strategy is just going to require a lot less time because we don't have to meet the 750 hour test or more than half our time. And if you have a spouse that's a homemaker, there's not really an issue with the more than half of your test. So short-term rental strategy, so we're looking at buying a short-term rental, average stay of 7 days or less is what we're looking at. Pretty typical Airbnbs, a good vacation market, things like that. We're also going to talk about then if we've met it and we make the short-term rental non-passive to offset their non-passive W-2 income, then we want to accelerate as much as we can with a cost segregation study based on the purchase price to get as much bonus depreciation as we can, especially when we have 100% bonus depreciation here. And then third, I mentioned they've got some kids. In my example here, I'll say about 10 and 12. 12, they're old enough, the kids are old enough to perform meaningful work. And I'm going to assume for the moment, just like 98% of most parents I speak with, that they're going to say yes, they want to hire their children, they want to help them financially, they want to get them involved as long as they're old enough and it's practical for them and there's no sort of other reason why. So we'll talk about that. Oil and gas. Now, this is something that is, especially for high income earners, and if we're offsetting at a 32, 35, 37% rate, this can be very efficient and not require additional time, which is why I like it. However, it is a very different asset class. It's an alternative investment and a very different risk profile. So it's not something that I see every client get into like I do for more specifically the short-term rental strategy is almost more of a no-brainer for most people, but it is something that I'll discuss with them to say, hey, here's another opportunity. If you want to stack these together, fantastic. But if you want to spread out short-term rental this year, oil and gas next year, whatever it might be, that's great. And then entity structure. Some of you know that tax savings do not come from entity structure. So I'm going to explain more of that here in a little bit. But at the end of the day, if you properly structure this, sure, you can write off the cost as a business expense for creating new LLCs and working with the attorney, some of those legal and professional fees. So you could call that an extra deduction, sure. But at the end of the day, if you set this up improperly, it could also increase your annual tax preparation fees. Okay, I'm talking about like partnership tax returns and things like that. So here we go. Short-term rental strategy and cost segregation study. Okay, I just want to walk through some specifics. The next tab you're going to see here will actually look at the total savings in terms of dollars in reducing their tax liability. So here's what I would recommend, honestly. I would recommend a purchase price of about $500,000. They're making $500,000. I like to kind of see roughly that 1-to-1, or maybe a little bit more. Okay, if you're making multiple millions, that might just be a little bit impractical. Even if you're making $3 million to go buy $3 million of short-term rentals, maybe it is possible for you, great. But just for most people, $500,000, I'd recommend probably at least a $500,000 short-term rental. Now we're gonna assume that the building is about 80% and the land is the other 20%. Okay, so total here, you can see the 500. That's the first thing we need to do. And I'm using 80-20. That's a pretty typical rule of thumb for most US real estate. If you're buying a property that's in an ideal location on the water, on the lake, something else like that, you might be looking at something like 70-30, 60-40. I've got another video on reviewing a short-term rental property analysis for tax purposes, but let's just say 80-20 for the sake of this. And then let's assume they're gonna have about 25% of the $400,000 is going to be bonus depreciable eligible. So with that, okay, we've got $100,000 of extra losses to offset the $500,000. So if we stop there, we'd be looking at now not paying tax at, call it $500. We're kind of disregarding the standard deduction and anything else, but we'd be now paying tax at $400,000. Okay, that's great. So that would be one. And we're kind of combining these strategies together. They usually go hand in hand. Okay, you're not going to do a cost segregation study on every single property, but in this situation, 100% bonus depreciation, we're going to make it non-passive. Fantastic. That would be number one. Now, number two is the oil and gas investment. And again, like I said, I don't always have all of my clients that move forward with this immediately. They usually are coming to me, again, like we said with the goals earlier on the first tab, they're coming to me because they want to get into real estate. Okay, so this is not necessarily real estate. This is almost more like investing into a business that happens to extract the gas, oil out of the ground, and then they're usually selling to someone else, okay, who's then going to refine it. But I usually will see someone wanting to make an investment of roughly somewhere around 100,000, maybe 150, 200, and that is going to produce, if you follow it correctly, I'm not going to explain all the details here, but that can produce 100% of your investment can come back to you in the form of 100% of your loss, and non-passive as well, which is the benefit of the short-term rental strategy. Okay, so it's kind of a 1-for-1, 100,000 in, 100,000 deduction. We'll get into the actual tax savings here on the next slide, but that would be number two. And the beautiful thing about that is it does not require material participation, whereas the short-term rental strategy does. So it's a difference in time requirement, but also risk profile and asset and things like that. Number three, and this is not going to be a huge one, but it is something that, again, very often I see parents are very excited to get their kids involved in their business and just to get their kids experience and things like that, even if it's before the age of 14, because they want to have them earn some money and they want to have them be busy and they want to have them, like I said, get the experience and the financial benefits, things like that. So let's just say they've got the two kids, okay? And let's say probably over the course of the year, maybe over the course of mostly the summer when they're outside of school, they put in 250 hours, okay? Each kid puts in 250 and they might make maybe minimum wage at, call it $10, just for the sake of example, every every state and locale is a little bit different. That would be basically a $5,000 wage deduction that's then going to go to the kids, but it's going to be a deduction for the business itself. Okay. And you might say, wow, that's a lot of time for maybe one property and things like that. I get that. And that's true. But just for the sake of helping them understand some of the mechanics and why this might be worthwhile, we're just going to use that as an example. And maybe they go to the property with their kids, they're doing all sorts of setup, and that's part of their material participation, all those things there. Okay. So that's $5,000 as a deduction, an extra expense, which is likely going to be related to the short-term rental, like I said, but that's then going to be tax-free income to the kids. Right? The kids are usually going to make $250, like $2,500. That's not going to be something that's going to trigger that they now have to pay tax. Okay. So we're going to use that and say $5,000, great, an extra deduction, again, associated over here to the short-term rental. And then entity structure. Okay. So often do I see questions about entity structure that I like to cover it for just almost everyone, right? LLCs, S Corps, C Corps, partnerships, Wyoming, Nevada, Delaware, all those things. Okay. A proper structure working with an attorney, depending on how many layers and how many LLCs and which states and all those things, it's going to cost you a few $1,000s. Okay. Let's just say it's somewhere between $5,000 to $7,500, could be $10,000. Okay. Depending on who you're using, timing, all those sorts of things. Okay. So let's say that's going to be an extra $7,500 expense. So all these things combined, we've got the 100, extra 100, that's a negative there. We've got the 5, and then we've got the 75. So an extra $212,500 in extra deductions if we move forward with this. Okay, so with that $212,000, before we move on, I realized I wanted to say one other thing. So as we talk about the short-term rental tax strategy, I really like this, especially when we have a spouse that is not working full-time, okay? Because that spouse, again, don't have to meet 750 hours, not real estate professional status with long-term rentals. We're just going for material participation. And usually my clients that I work with are gonna shoot for that 100 hours and more than anyone else test. They're not usually shooting for 500 hours. That's a lot of time. Obviously it's less than the 750, but oftentimes it's a property, they're gonna improve it, they're gonna furnish it, they're gonna do all the setup, the initial clean, manage it maybe for the first year or so, and that's gonna get them 100, 150, 200 hours, okay? And that's good, okay? I like that. And the other spouse that's not working could fully take that over, right? It could be basically their job, and that's gonna accelerate a lot of tax savings for them here in this year. The other thing I realized I wanted to say, entity structure. For the most part, I've got another video on this, so feel free to go look at that as well. For the most part, they're gonna have this short-term rental, as long as they're not planning to refinance really quickly, into a single member LLC in the state of wherever the property is, okay? That's then, if they're planning to grow more and more and more, which is very typical for my clients, they're gonna have that LLC be owned by a holding company, usually registered in Wyoming. And then on top of that, they're gonna have a revocable living trust. That's going to be a joint revocable living trust. It's a single one with both taxpayers in that. And that's going to be a very good structure for them to scale. They'll just have more LLCs below the holding company. They've got some estate planning. They've got some anonymity with the state of Wyoming, things like that. Okay. So I like this structure, gives them some asset protection, some estate planning, that liability protection. They've got the kids working, getting some of that deduction, helping them financially and with some experience. They've also got some alternative investments that they can alternate between short-term rentals and oil and gas, or if they're just super busy and they can't find it, or it's a bad market, something like that, and they want to get some additional exposure for diversification. And obviously this is the core strategy of why they're wanting to work with me, to make sure that they pull this off correctly. Okay, there's a lot of information out there, but they want to do this correctly and remove the risk as much as seemingly possible by working with someone who's done this a few hundred times. Now, moving on to the big part, kind of pillar 3 here, of the actual tax savings. So let's run the numbers on what the actual tax bill difference is going to be. And there's going to be some additional numbers here. Hang tight, I'm going to explain certain things here in just a minute. Okay, so now we've got the kids. And then lastly, we have the entity structure. So like I said, you're probably gonna 5,000, 7,500, 10,000, just depends on who you work with in the structure. But let's just say that that's about, again, 28%, excuse me. And that's going to equate to another tax savings of $2,100. Again, great, you're going to pay for that. Maybe that feels like a silly deduction, but so be it. But also the thing I just wanted to show you is that if you are going to do this correctly and you're not going to accidentally have a partnership tax return moving forward, you're going to save $1,500, $2,000, $2,500, whatever it might be, in fees on an annual basis. Because if you start having these partnership tax returns and you unintentionally do that and you don't want that with your spouse, then you're accidentally having to pay that additional fee annually. And your CPA might be like, oh great, I've got another tax return I can file, that's more revenue. I do not think that way, because one, I don't want to have to file additional tax returns for you unnecessarily, but two, it just doesn't benefit you for the most part, especially from a tax perspective. An attorney might have a different interpretation on that for specific reasons that might be necessary, but make sure that it's clear to you that why you're doing that from a legal perspective, that's different. But ultimately, kind of total savings here between the two of just tax savings and the fees of $4,600. So let's get to the kind of the bottom line. The original tax liability I showed you is about $103,000. Okay, now I'm rounding here, but the new tax liability after all the savings of $60,000, $61,000, whatever it is now about $42,000. Okay, so for hopefully most of you, that's a very exciting number because we've actually saved more in taxes than the actual liability itself originally. So we're cutting down taxes like more than in half. Okay, that's fantastic through all these things. And yes, you're gonna have to put in some time, you're gonna have to put in some investment and some capital and do all some of these new things, right? It's gonna take some time to get used to. If your goal is tax savings and you're willing to do these things, this is what this can look like for your situation. So total savings, including all the fees that I mentioned, $63,000. This is usually the highlight that people are looking at, of about $60,000. We'll just round and keep it simple, $61,000. Now, what happens in year two? Year two can look similar, except for we'd be taking this out probably completely. Maybe you keep this, but you're not gonna have this expense. Year two, depending on what you do, could look the same, okay? Again, except we take this out, okay? So call it 60,000, just under 60,000 again. And honestly, this might increase more if you've got a second property in the second year. So just keep in mind, and especially depending on how the taxable profit or loss from your first short-term rental, how that looks in the second year, we could be kind of growing and growing that kind of non-passive loss moving forward as well. But point is, especially as you're getting your second or your third or your fourth, or you're doing different things, or you're saying, hey, I'm just gonna commit to doing this year. And then next year I want to revisit this. Or hey, now my kids are actually over 8 and I want to start doing this. Or hey, I'm ready to start setting up this full structure next year, but for now I'm just going to do a single member LLC. These things are going to change and transpire. And so working with someone like me on an annual basis usually makes a lot of sense, but we don't have to do this in-depth type thing on an annual basis. This is kind of a first year setup, really get you comfortable with some of these things and these topics and how we document this and do it right. And then on the years moving forward, we can kind of tailor things to really what you're looking for moving forward, depending on what you do moving forward. So that's what some of tax planning looks like with me and working with a W-2 earner who's making about $500,000 a year. And I want to be clear here that every plan I build is different because everyone's situation and goals are different too. The income is different, the state is different, goals, whatever it might be. But the process I just walked you through is pretty similar for almost all of my clients. If you want to understand some of these core strategies that we walk through, you can watch some of my other videos on cost segregation study, the short-term rental strategy, entity structure, things like that. And if you do, great, I'll see you in those videos next.